Welcome back to Street Smart. Economists from all over are gathering today at the New Economic Thinking Conference in Bretton Woods, New Hampshire. Bloomberg's economic editor Mike McKee has been rubbing elbows with renowned economists all day. Right now he joins us with Dr. Henry Kaufman. He's president of Kaufman Co. Mike, all yours.
Yeah, Carol, we were just talking about all the eminent economists who are here, and Henry Kaufman is certainly one of them. You've been an observer of the global financial scene for a very long time. We were talking just before the break about how there's a feeling that something has to give, something has to change to manage the financial system of the future. If you had the power to make one change, what would it be?
The one change that I would make is to take large, complex financial institutions and bring them down to a size so that they are not too big to fail. I think that is really an overriding issue. It's an overriding issue because large financial institutions, number one, are not efficient. Number two, when they become so large, they have to be protected by the government, which has been the case in the last 3-4 years, and around the world. Large institutions, in many ways, as they become bigger and bigger and dominate the financial system, are going to be socialized institutions.
But how big is too big? How do you decide what the size is optimal?
Well, that is a judgment call. But a lot of things are judgment calls. There's no perfection in quantitative analysis, as we have seen in economics and finance in the last couple of decades. The need for supervision and regulation is always to come up with a better mousetrap, with a better cheese, so that those who disobey get caught early rather than after.
Well, do you manage the institutions we have as they are now, or does Tim Geithner and the Systemic Risk Committee go to Bank of America, go to Citibank or somebody and say, no, you have to spin off something?
I think the way to do it is to ask large institutions to spin off parts of their business. Their trading business, their underwriting business, their management of money business, their money market business. All that can be done by other specialized institutions, perhaps even improving the efficiency of the operation. We've already seen here where the system is beginning to go back to the very acts that it was committing in the past. Let me give you an example. We recently had an announcement that AT&T was going to acquire T-Mobile. And one of the most prominent institutions in the United States was the key underwriter and the key lender. Now, those two do not reconcile well, to be the key lender and to be the key underwriter. There are potential conflicts of interest. That's what got us into trouble to some extent in the past.
Well, there's an argument that this is very difficult to do now, and you look simply at the Dodd-Frank requirement that you spin off your prop trading desks. Yeah. Basically, all these institutions moved their prop traders to another division, called them something else, but they're still there.
That is correct. So what you have to do is indicate that there can be no prop trading whatsoever, and that the investment banking business and the money management business is completely segregated from the deposit function of a financial institution. And we've gone a long way to avoid this. We have moved, really, in the United States from a system that functioned quite well in the 50s and in the 60s to a European-style sort of system. The system that prevailed, particularly on the continent of Europe, of the universal banking institution. The universal banking institution gets involved with its government, with its labor and social practices and so on, and that is not an effective economic system, unfortunately.
You came from Salomon Brothers,
yes,
which was known for its financial innovation. They invented many of the products
yes.
in the bond market today. Banks argue they need a lot of the flexibility and size that they have now to continue financial innovation. Is financial innovation that important? Has it been a benefit?
Some financial innovation has a benefit. When it goes to an extreme, when you take securitization and you warehouse securitized loans and then try to sell them out, and you have no oversight responsibility over those assets, I think it's not a benefit. You create too much debt. You create too many marginal borrowers. You create too many mortgages where the credit that's behind it is not valid. And that contributed to a serious problem in the United States. Today, many mortgage holders, many homeowners have no equity anymore. And we overextended the use of credit. And the idea of liquidity was completely shifted from an asset idea of what you have in the bank, the securities you own, to your capacity to quickly borrow. That credit card in your pocket was your source of liquidity. And for many Americans, not realizing that credit card was really not liquidity, it was a potential liability.
Quick question, less than 30 seconds. Big fight going on in Washington over the budget. A lot of people say the real issue is the debt limit. As a longtime bond market observer, no reaction so far. Should we be worried?
I think the debt limit will be extended. This is a political showmanship. The government cannot be shut down. Too many Americans will be marching on Washington because of the shutdown if it prevails too long. The whole issue is the issue of what the Democrats and Republicans will propose in the next presidential campaign.
Henry Kaufman of Henry Kaufman & Company, thank you for joining us. Always great to talk to you. We're going to send it back to you now, Matt and Carol.